What's happening right now in the precious metals market is absolutely extraordinary. While everyone's been watching stock indices and crypto prices, something historic is unfolding in silver and gold that very few people are talking about. Today, January 13th, 2026, silver is trading at $87 per ounce. Gold just hit a new all-time high above $4,600 per ounce. But here's what's really remarkable. The gold to silver ratio has dropped to 56 to 1. Let me put that in perspective. This means it takes only 56 ounces of silver to buy 1 ounce of gold. The historical average? 65 to 1. But we've been as high as 125 to 1 just a few years ago. When this ratio moves dramatically, it's not just a technical indicator, it's a warning signal. It's telling us something fundamental is shifting in the global financial system. And if history is any guide, what comes next could be explosive. I'm going to break down exactly what this means, compare it to every major financial crisis in modern history, and show you why this might be one of the most important indicators you're not paying attention to. Let's start with the basics. The gold to silver ratio is simple to calculate. You take the current price of gold and divide it by the current price of silver. Right now, with gold at $4,600 and silver at $87, we get approximately 53 ounces of silver per ounce of gold. Some sources are reporting 56 to 1. And that slight difference comes from timing and exact pricing, but we're in that range. Why does this ratio matter? Because it tells us about relative value between these two precious metals. More importantly, it tells us about market psychology, economic stress, and where smart money is flowing. Throughout history, this ratio hasn't been fixed. In ancient Rome, it was set at 12 to 1. The first Egyptian pharaoh, Menes, established it at 2.5 to 1 around 3000 BC. The U.S. Coinage Act of 1792 fixed it at 15 to 1. But since 1971, when Nixon ended the gold standard and both metals started floating freely in the market, the ratio has typically ranged between 50 to 1 and 80 to 1. The long-term average since then, about 65 to 1. So at 56 to 1, we're currently below the historical average. That tells us something crucial. Silver is outperforming gold. And when silver outperforms gold, it's usually not because things are going well. It's because investors are hedging against something much bigger than just inflation. Let me take you back to 2008, because what's happening now rhymes perfectly with what happened then. In early 2008, before the crisis fully unfolded, gold was climbing, but silver was lagging. The ratio started moving upward in August 2008, a full month before Lehman Brothers collapsed in September. The market was giving us an advance warning. By the time the crisis peaked in late 2008, the ratio had spiked to approximately 80 to 1. Gold dropped 34% from $1,034 to $681. But silver? Silver was absolutely massacred. It fell over 60% from $21 to just $8.40. Why did silver fall so much harder? Because silver is not just a monetary metal, it's also an industrial metal. When the global economy collapsed, industrial demand evaporated. Manufacturing stopped. Electronics production halted. Solar panel installation froze. Silver, being used in all these applications, got hit from both sides. But here's where it gets interesting. After that spike to 80 to 1 in late 2008, something remarkable happened. From 2008 to 2011, the ratio collapsed from 80 to 1 all the way down to 32 to 1. During that same period, silver went from $10 to nearly $50 per ounce. That's a 400% gain. Gold also rose during this time, but silver rose 3 times faster. If you had bought silver at the peak of the ratio in 2008 and held it through 2011, you would have made extraordinary returns. The pattern is clear. During the initial crisis, fear drives money to gold, the ratio spikes. Then, as central banks respond with massive stimulus, monetary debasement fears take over and silver catches up violently. Fast forward to March 2020. The COVID pandemic hit and we saw history repeat itself, but on steroids. The gold to silver ratio exploded to an all-time modern high of 125 to 1. This had never happened before in recorded market history. Silver crashed to below $12 per ounce in March 2020, the lowest level since 2009. Gold, meanwhile, held relatively steady, around $1,700. Again, the pattern. Crisis hits, industrial demand collapses, silver gets crushed, the ratio spikes to extremes. But just like 2008, this didn't last. What happened next? The Federal Reserve and central banks around the world unleashed unprecedented monetary stimulus. The U.S. Treasury borrowed $530 billion in just 3 months, from July to September 2008, after the initial crisis. During COVID, we're talking trillions. All that liquidity had to go somewhere, and precious metals, being the ultimate store of value, absorbed massive flows. From that March 2020 low of 125 to 1, the ratio plummeted to 62 to 1 by mid-2020. Silver surged 104% in just months. The people who understood this pattern made fortunes. The people who panicked and sold at the bottom, they got wiped out. Let's zoom out even further, because this pattern isn't new. It's been playing out for decades. In the 1970s, after Nixon abandoned the gold standard, gold began its bull market first. Silver lagged behind. But then, late in the decade, silver staged an explosive rally that drove the ratio down dramatically. By 1980, the ratio hit approximately 17-1, one of the tightest readings in modern history. In the early 2000s, after the dot-com crash, we saw the same thing. Gold started its bull market around 2001. Silver initially lagged. The ratio peaked above 80-1 in the mid-2000s. Then silver caught up with fury. From 2008 to 2011, as I mentioned, silver outpaced gold by a factor of 3. In 2016, during another period of economic uncertainty, the ratio hit 94-1. What followed? Silver gained 47% in the subsequent rally, while gold gained 25%. The pattern repeats, crisis strikes, ratio spikes, silver gets oversold, then silver explosively catches up as monetary stimulus floods the system and industrial demand recovers. Now let's talk about today. January 13th, 2026. Silver has just reached $87 per ounce. 1 year ago, in January 2025, silver was trading at $29. Now that's a 180% gain in 12 months. While the S&P 500 has barely moved, gold is above $4,600, up from around $2,670 a year ago. That's about a 72% gain. Impressive, but silver is outperforming gold by more than 2-1. The gold to silver ratio has compressed to 56-1. This is below the historical average of 65-1. This is telling us that silver is not just catching up to gold, it's leading. What's driving this? Let's be very clear about what's happening in the world right now. First, there are serious questions about Federal Reserve independence. U.S. prosecutors have opened an investigation into Fed Chair Jerome Powell. This is unprecedented. The Trump administration is pressuring the Fed to cut interest rates. This threatens the very foundation of central bank independence that markets rely on. Second, geopolitical tensions are exploding. Iran is experiencing massive protests. The U.S. is threatening military intervention. Venezuela's leadership has been removed. President Trump is talking about annexing Greenland and potentially using military force. Trade wars are escalating with threats of 25% tariffs. Third, the U.S. dollar's dominance is being questioned. Central banks, led by China, are buying gold at record rates. China has extended its gold buying streak to 14 consecutive months. They're diversifying away from dollar reserves. Fourth, fiscal deficits in the U.S. and other nations are mounting to unsustainable levels. This is encouraging precious metals demand as a hedge against currency debasement. But here's the key factor that many analysts are missing. Silver's industrial demand is stronger than ever. Solar panel installations are booming globally. Every solar panel requires silver for photovoltaic cells. Electronics manufacturing is expanding. Medical devices need silver. Electric vehicle production is accelerating. The Silver Institute projected that the silver market would be in deficit for the 5th consecutive year in 2025. The cumulative deficit is approaching 820 million ounces. That means demand exceeds supply year after year, and this gap is widening. So how does our current situation compare to past crises? In 2008, the ratio spiked to 80-1 during the crisis, then fell to 32-1 by 2011. If we experience a similar compression from today's level of 56-1, we could see the ratio fall to the low 30s or even high 20s. What would that mean for prices? If gold stays at $4,600 and the ratio falls to 35-1, silver would need to reach $131 per ounce. If the ratio falls to 30-1, silver would need to hit $153. But gold isn't going to stay flat. HSBC Bank recently said trading momentum could carry gold to $5,000 per ounce in the first half of 2026. If gold hits $5,000 and the ratio compresses to 35-1, silver would be at $143. At a ratio of 30-1, silver would be at $167. Bank of America has issued forecasts suggesting silver could top out between $135 and $309 in this cycle. That's not fringe thinking. That's major Wall Street banks recognizing the supply-demand fundamentals. Now, some analysts are more conservative. They point out that silver's industrial nature means it might not compress the ratio as dramatically as in past cycles. A forceful mean reversion might stall around 60-70 rather than pushing to the sub-40 extremes of earlier cycles. But even in a conservative scenario, if the ratio simply reverts to its historical average of 65-1 and gold is at $4,600, silver would be at $71. We're already at 87, which tells us we're in the early stages of silver outperformance. Let's cut through all the numbers and get to what this really means. The gold to silver ratio dropping to 56-1 is telling us several crucial things. 1. This is not normal diversification. When silver moves this fast relative to gold, institutions aren't just diversifying. They're hedging against currency collapse. They're buying insurance against everything breaking down. As one analyst put it, silver is the poor man's apocalypse hedge. 2. The market is pricing in systemic risk that stock indexes are ignoring. The S&P 500 hasn't reflected the level of risk that precious metals are pricing in. This disconnect won't last forever. Either stocks will correct to reflect reality, or the system will prove more resilient and metals will pull back. History suggests the former is more likely. 3. We're seeing the same pattern as 2008 and 2020, just moving faster. Markets are learning from past cycles. The initial crisis spike in the ratio happened. We saw it during various stress points in recent years when the ratio pushed above 100. Now, we're in the compression phase where silver catches up, and it's happening faster than previous cycles. 4. Industrial demand provides a floor under silver that didn't exist decades ago. The 1980 silver spike was largely speculative. The 2011 spike was driven by investment demand. But today, we have structural industrial demand from solar, electronics, and EVs that creates persistent deficits. This changes the game entirely. 5. Central bank behavior is validating the trend. When China buys gold for 14 consecutive months, that's not market timing. That's a strategic shift away from dollar dependence. And when major nations diversify reserves, it signals a fundamental change in the global monetary system. Now, let me be clear about the risks, because no analysis is complete without discussing what could go wrong. The ratio could stop compressing here. If we enter a deflationary recession where industrial demand truly collapses, silver could underperform again. If gold surges, while silver stalls due to weak manufacturing, we could see the ratio widen back towards 70 or 80. There's also the possibility that this rally is primarily driven by speculative flows rather than fundamental demand. If that's the case, a sharp correction could happen when speculators exit. Additionally, major silver discoveries or breakthrough mining technologies could ease the supply deficit. New production coming online could cap silver's upside. And finally, if geopolitical tensions ease and confidence in the dollar strengthens, both metals could correct together, though silver might fall harder given its higher volatility. But when we weigh the probabilities, the evidence leans heavily toward continued silver strength. The supply deficit is real and measured. Industrial demand is growing, not shrinking. Central bank behavior indicates a long-term shift. And the historical pattern of ratio compression during monetary expansion is well established. So what does the gold to silver ratio at 56-1 mean for your money? It means we're in a historic moment. Silver at $87 is not the end of this move. It's likely the beginning or middle phase. If historical patterns hold, and if the ratio continues compressing toward its crisis averages in the 30s, we could see silver at 130, 150, or even higher before this cycle peaks. For investors, this is about understanding cycles and positioning accordingly. It's about recognizing that when the gold to silver ratio drops below its long-term average, while both metals are in strong uptrends, something significant is happening beneath the surface of financial markets. The ratio is not just a technical indicator, it's a stress gauge for the entire financial system. It's telling us that confidence in fiat currencies is eroding. It's telling us that safe haven demand is accelerating. And it's telling us that silver, the volatile industrial monetary hybrid metal, is attracting flows at a pace that suggests smart money is positioning for major turbulence ahead. Whether you choose to act on this information is up to you. But don't say you weren't warned. The gold to silver ratio has been flashing warning signals for months. And history shows that when this ratio moves dramatically, fortunes are made and lost based on who understood the pattern and who ignored it. Pay attention to this ratio, track it weekly. And understand that we're watching a monetary transformation unfold in real time. The gold to silver ratio at 56-1 is not just a number, it's a message. And that message is, prepare accordingly.